Good afternoon. It is Monday, February 21st, I believe, President's Day. So happy President's Day to you. The office is closed. I'm here doing a little work catching up on in casual mode. And I wanted to take an opportunity to throw a quick video at you to cover a few things. Did you know that the mortgage APR is what your payment is based on? Did you also know that everyone should do a 15-year loan? Did you also know that it's not a good idea to pay points? They're not worth it. The lender just makes more money. Did you also know that the break-even point, that's the point where the savings of the loan pay for any cost associated with the loan? Did you know that break-even point needs to be 3 years or less to make it worth it? Also, did you know that if you can save at least 1% on the interest rate, it's a great idea to look into refinancing? Did you also know that everything I told you is complete bullshit? Sorry, but yes, it is. There's a ton of inaccurate and outdated information out there as it pertains to mortgages on the internet. So much information. I wanted to address this, but there's so much bad information, I almost didn't know where to start. So what I did is I grabbed a handful of those videos and pulled out, say, the top 5 most popular bad information comments I found, and I'm going to address those between this video and another video. So in this video, I'm going to address the first 2, the APR and the thing about the 15-year loan, and in the next video, I'll do the other 3. So let's get started with the APR. So the APR, this comment came from a radio show, a popular radio show, and one of the hosts mentioned the APR is what your payment is based on. That, of course, is totally incorrect. The formula for the APR is not really that important to know, but just to give a little background, the APR is the product of a math formula that factors in the term of the loan, whether it's 15, 30, 20 year, the loan amount, fees added into the loan, and the advertised rate, that I call it the note rate, that one that you see. That product is then expressed as an annual rate, and that's your APR. More importantly is how you use that to save money as a shopper. There are 2 ways you can use it. The first way is you can use the APR to determine if there's fees associated with that advertised rate at a glance. The higher the APR is above the advertised rate indicates fees associated with that rate. Example, you see a 3.875 interest rate with a 3.875% APR. The rate and the APR are the same, so that indicates that there are no fees associated with that advertised rate. If you see a rate of 3.875 and an APR of 4.4 something, that indicates there are fees associated with that rate. The APR is higher than the advertised rate, and the higher that APR is above the advertised rate indicates more and more fees. So this is so at a glance you can determine if there's fees associated with that rate. The second way you can use it is to determine which rate will save you more money in the long run. Now, this is not comparing one lender to another. This is comparing one rate to another. I'll put a link in the description to a video I did where I compared a 2% rate to a 2.875% rate. The 2% rate had about $19,000 in closing fees, and the 2.875% rate had no fees. And I used a 20-year loan example. Long story short, the 2% rate, even though it had $19,000 more in fees, it saved $24,000 more over the term of the loan after doing all the calculations. Well, the easy way to determine that is just looking at the APR. The APR for the 2% rate was about 2.6. The APR for the 2.875% rate was about 2.8. The lower APR of the 2% rate lets you know that over the 20 years, that 2% rate is going to save you more money. That's how the APR can be used. Both ways the APR can be used. The APR is a tool. It's not some type of top secret that the lender is trying to keep from you. In fact, when we quote your rate, we're required to quote you the APR also. I'm going to put a link in the description to the Consumer Financial Protection Bureau, the CFPB website, where they explain to you the APR, so you don't just hear it from me, you can read it from the horse's mouth on the website. All right, so that does it for the APR. Let's go into the next one now. We're going to talk about everyone should do a 15-year loan. This also came from a video, a radio show. Now I'm going to look on here. The caller, he was in a 30-year loan at 3.75, and he had an opportunity to refinance into a 15-year loan at 2.125%. They didn't mention the payment in the video, but I calculated based on the information in the video that his payment on the new 15-year loan would be about $2,360. His yearly interest savings, I calculated to be about $5,800, if he went from the 30-year loan that we mentioned to that 15-year loan. The caller also revealed that he planned to move in 18 months. Then finally, the caller also mentioned that he is going to be bringing $10,000 to closing to pay his loan balance down, so he'll be at 80% loan to value so he can avoid private mortgage insurance, PMI. Both of the hosts, there were two hosts, both of the hosts encouraged him to proceed with the loan. There are a few things wrong with this scenario, not just doing a 15-year loan when you're moving in 18 months, but let's jump into that. So let's first talk about the private mortgage insurance and this $10,000. I estimated, they didn't mention this in the video, but I estimated based on the information available that his PMI was about $185 to $200 a month. And if he were going to be living in there for 18 more months, that would be $3,600. Now 200, right? 200 times 18, $3,600 that he would be saving by getting rid of the PMI. But he's bringing $10,000. I'm pulling that out of, I don't know where, savings account, checking account, to pay that down so he can get rid of that PMI. So you're paying $10,000 to save $3,600. I'm not a math genius, but that doesn't really seem to work out with me. The next thing here in the video that I noticed was that the 15-year payment would be about $850 higher than a 30-year payment. So what I was thinking, the route I would have taken, is looking into lender-paid mortgage insurance. We call it LPMI. Back at the time this video was done, the 0 points rate for this gentleman's scenario was about 2.625%. Now with lender-paid mortgage insurance, you bump the rate up a little bit higher in exchange for not having mortgage insurance. So instead of 2.625, he could have got the LPMI, lender-paid mortgage insurance loan, for 2.875, and there'd be no mortgage insurance. The payment on that would come to about $1,506 or so. Let's just say it's $1,500 on that 30-year fixed. So that would save, or not save, compared to the 15-year loan. How about that? That's $850 a month more in your pocket, which is, what is that, about, $15,000 or so, $15,500 or so more in your pocket. just checking out some more of the notes here. So that's why I didn't know, if you're going to be moving out, why do that 15-year loan? Why not do this one? Anyway, it is true that over the 18 months, if you did the loan and stayed in the house for 18 months, it is true the 15-year loan with the lower 2.125 interest rate would save or pay the principal down about $19,000, approximately $19,000 more than the 30-year loan. But you're also $15,500 out of pocket. And the only way to make that back up is when you sell the home. And there's no guarantee what you're going to sell the home for 18 months later. You've also got the agency fees and other costs to sell involved here. So there's no guarantee you're going to make that money back up. I would say, you just got to take the bird in the hand, and you take the save $10,000 and go with the lender paid mortgage insurance loan, and $15,500 from a 30-year payment compared to a 15-year payment. And it's like $25,000. That makes a little more sense to me. Here's how in real life we would have approached a situation like that. An experienced mortgage loan originator, we would have found out what this gentleman's goals were in detail. Listen to his goals. Even if the goals sounded a little bit crazy, don't belittle them. Listen to the goals. Then determine the needs, because the needs and the goals don't always match up. Then we would have gotten to the numbers, calculating the housing expense ratio. That is how much of the income is going towards housing expense, like the principal and interest, taxes, and insurance. Then we calculate debt to income ratio, the popular one, which is how much of your income is going towards the housing expense plus your consumer debts. And then we calculate the residual income. How much do you have left over after paying all that stuff? Then we probe on a 15-year loan. You're going to probe for future problems with income. Like say if they're a dual income household, are you both going to be working for the duration of this 15-year loan? Somebody going to retire? Somebody going to lose their job? God forbid, somebody going to quit their job? And if that happens, can you afford this 15-year loan comfortably on a single income? We need to ask those probing questions. And then finally, we're going to circle back around to those goals. A lot of times when you're talking things through with people, those little goals can change a little bit or modify a little bit because they start seeing more of the light as you present new information to them. And we would ask them, so you definitely going to stay here for for another 18 months? I mean, you're definitely going to be punching out after 18 months? I mean, what are you going to do? Are you going to rent afterwards? You're going to buy another place? What are your plans? We're just talking it through with them just to solidify their goals. Then when that's all done, we come up with the plan. Now, let's say this gentleman heard from somebody that, hey, you want to do a 15-year loan always. So we would definitely give him the 15-year loan presentation, but also one or two more options. I would definitely do that. So in addition to the 15-year loan, I would give him a 20-year loan option and a 30-year loan option, so he can make an informed decision on his, with the information available, make a smarter decision. Now, in all fairness to the talk show hosts, they're only talking to people for 90 seconds. For us, when we're talking to customers, it's nothing for us to talk to someone for an hour and a half, just on the first phone call alone to go through this discovery process. We can't afford to use quick fix, one-liner guru techniques. And that's a lot of what I see out there. Oh, if it's 1%, you could refinance. Oh, if it's 3 years less, then it's a good idea for the break even. And that quick fix stuff doesn't work. There's too many different scenarios amongst all these different people out there. There's different problems, different goals, different loan to values, different loan amounts, different credit scores, different income types. There's too many differences to use general quick fix guru terms. All right. So, in wrapping this up, I got to mention this. I can't help but mention this. When I was researching these videos, one possible solution to this problem of a lot of bad mortgage information being out there is to get more experienced mortgage loan originators to create content, to write articles, to put the videos out there, because these videos that I've seen, most of these videos, well, so far all of the videos, there's more to look at that I've seen out there that have this bad or outdated information were created by individuals that are not in the mortgage industry. Maybe they're working in parallel industries. Maybe they're financial writers. They write on financial topics. Maybe they're financial experts in other fields, but they're not licensed or experienced mortgage loan originators. So you're prone to make mistakes. When that happens, I'm not coming down on them. It just seems to be a fact here. Giving expert advice when you're not a subject matter expert could be harmful to consumers. I'll give you just one quick last example before we go here. I'm a California licensed real estate broker, card carrying. I think I'm card carrying. Nice on casual day here. Yep, card carrying licensed real estate broker. I've got my corporate license and my individual broker's license right here. A broker's license, what that allows you to do is, of course, buy and sell real estate. It's a company level license, so it also allows you to hire agents to work under you, like maybe those shows if you watch Netflix, like that's Selling Sunset, one of my favorite shows, where they have, one of the gentlemen is the broker and the sales agents are working for them. That's what the broker's license is. I've also been doing this for 24 years. During that 24 years, I've worked with a lot of real estate agents and brokers. And also, naturally, a lot of my friends, some of my closest friends, are real estate agents. So I've been around real estate a long time. I'm licensed. So when it comes to me giving expert real estate advice, I shut the hell up. I'm not a professional real estate practitioner. I'm not out there like I see the hardcore, knowledgeable, experienced agents. They're out there selling and buying real estate 6 and 7 days a week, and they've been doing so for years and years. When someone talks to me about real estate advice, the closest I'll get to giving advice is, you know what, I think, but you really should talk to your agent. And if they don't have an agent, I refer them to an experienced agent, because I know what it is that I don't know, or I don't know what I don't know. I'm not going to give out professional real estate or expert or advice as an expert if I'm not an expert in that field. So I just wanted to close with that. I'm going to address those other 3 bad information comments in the second video. Hope this helped you out. Like and subscribe, and visit the website. We'll put some links in the video, UnitedRealEstateCapital.com or ure.capital. Thank you so much. Look forward to seeing you soon. Have a great rest of your day.